The Federal Reserve has been consistently raising interest rates now since March 2022. Over the last year or so, rising interest rates have made US Treasury bills more attractive for investors looking for higher returns. US Treasury bills, also known as T-bills, are a type of short-term debt instrument. Because they cover the US government's short-term financing needs, US T-bills will often have a maturity ranging from just a few to 52 weeks. Some of these T-bills, specifically the 3 and 6-month bills, are now offering investors a 4.99 and a 4.97% annualized yield. However, it's worth noting that even with this attractive yield, T-bills fail to match current inflation levels. With this in mind, here are 3 reasons why gold makes for a better investment than US Treasury bills right now. Remember to subscribe and click the bell icon if you'd like to learn more about investing in gold so that you're able to make better informed investment decisions. After all, the best investments tend to be the best informed investments. Buy the gold rush with a gold nugget. Reason number 1. Gold has an unlimited upside price potential, especially during stress periods. To a lot of investors, gold may seem too expensive to buy right now. The reality, however, is that gold has an unlimited upside price potential. In fact, gold isn't at its most expensive right now, but was at its most expensive in 1980 when an ounce of gold cost $800, which is equivalent to just under $3,000 today when adjusting for inflation. The reality is that even with gold's high price today of $2,000 per ounce, central banks all around the world are buying gold up at an unprecedented rate. Central banks are estimated to have purchased a whopping 1,100 tons of gold worth around $70 billion in 2022 alone. That's more than any other year since records first began in 1950, amounting to a third of the world's annual gold production. Due to its unlimited upside price potential, gold can perform significantly better than T-bills, which can only ever be redeemed for 100% of their face value. This is especially true during periods of geopolitical crises or when the annual rate of inflation is above the 5 to 6% level. Gold prices increase much more rapidly than the overall rate of inflation, while T-bill yields often end up tailing inflation. For example, when inflation reached dizzying heights of 23% in the United Kingdom in the 1970s, gold appreciated by a staggering 382.9% over the same decade. Bonds, on the other hand, brought in negative returns of minus 33.8%. This is because the markets which set gold prices are always forward-looking or anticipatory. T-bill yields, on the other hand, are controlled by central bank monetary policy, which tends to be backwards-looking or reactionary. Just think about how long it took the Federal Reserve to do anything about inflation. Perhaps a little too long. In fact, when we look at historical events such as the Yom Kippur War and the Iranian Revolution, we find that interest rates did not rise up fast enough to keep up with the rise in inflation. This delay in enacting effective monetary policy produced situations where gold provided investors returns of up to 160%, while the real yield of US Treasury bills turned negative. Reason number 2. Unlike US Treasury bills, which are created in response to the government's financing needs, gold protects investors from the ever-increasing money supply. There are only around 50,000 tons of gold left here on Earth, which scientists expect us to consume entirely within the next 16 to 20 years. Gold is therefore unlike any other asset as it is finite, meaning that we can't make any more of it. While the government can always create more T-bills, T-notes, T-bonds to fill its ever-growing financing needs, fortunately for both you and me, governments and central banks can't create more gold. Even if central banks raise interest rates, increasing the yield on T-bills, investors will still find themselves exposed to central banks' reckless money printing. To put that into perspective, due to the Federal Reserve raising interest rates, the US government has had to pay a record $213 billion in interest payments in the last quarter of 2022 alone, up $63 billion from the same period last year. Higher interest rates means higher interest payments for indebted governments, which, you guessed it, means more money printing in the long run. Gold, unlike T-bills, is immune from the manipulation of central banks. Reason number 3. Gold is more negatively correlated to equities than US Treasury bills. When studying the correlation of gold and US T-bills with the S&P 500, we find that gold prices correlate more negatively with the S&P 500 than US T-bills. Stocks typically provide investors with high returns and high risk. Thus, investors have often opted to diversify their investment portfolios with T-bills in an effort to reduce the risks and potential volatility. However, the evidence suggests that gold may be a better hedge against the volatility and risks of stocks than T-bills. During a bear stock market, investing in gold can significantly increase your overall returns. On the other hand, investing in gold during a bull market can help mitigate some of the risks associated with stock price volatility. International retail investors are taking note. Gold buying in the world's most populous countries, China and India, has returned to its pre-COVID levels in the third quarter of 2022, registering the highest demand for bars and coins since 2011. Gold is a better hedge against market volatility than T-bills are. And that's it for today. I hope you enjoyed this video and found it informative. If you'd like to learn more about investing in gold, then the best way to do that would be to subscribe to the channel and click the bell icon to be notified when we upload our next video next week. Buy the gold rush with a gold nugget.